Hello and welcome to Triage, timely conversations for healthcare professionals, a podcast created and produced by K&L Gates. Each episode is designed to highlight important developments in health law and analyze the impact on our clients and friends of the firm. We hope you enjoy this podcast.
Hello, my name is Andrea Cunha, and I'm a partner at K&L Gates in the healthcare and corporate practice groups. I join you today in this episode of Triage as a follow-up to a recent client alert we published relating to the key considerations for officers and directors of distressed companies. We still do not know the full financial impact that COVID-19 will have on companies, but expect that as government assistance eventually comes to an end, more and more companies will find themselves financially struggling. When a company's financial performance declines to the point where it is approaching insolvency, the company's directors and officers' fiduciary duties to stakeholders come to the forefront. When a company crosses that threshold to insolvency, there are additional considerations the company and the directors and officers need to consider. And so first you must look to see when is the company actually approaching that zone of insolvency. And there are three different tests. There's a cash flow test, which considers whether the company can pay its debts when they become due. There's a balance sheet test, whether the company's liabilities exceed the fair market value of its assets, and the adequate capital test, which considers whether there is sufficient cash on hand to pay operating expenses, capital expenditures, and debt repayment obligations. The failure of any one of these tests renders the company insolvent. And depending on the jurisdiction you are in is whether you are either approaching the zone of insolvency or actually are insolvent, of whether there's additional key stakeholders you need to consider. So therefore, directors and officers really need to be cognizant of a creditor's interests as well as the stockholders' interests when making decisions if they are approaching insolvency. Directors and officers of a company typically owe two duties. One is a duty of care to make informed decisions in good faith and in the best interest of the company. The other is a duty of loyalty, which requires the directors and officers not to engage in self-dealing and to put the interests of the company ahead of their own. This means that directors and officers should continually monitor and evaluate the company's financial performance and avoid being involved in any decision-making where there's a potential conflict of interest. Frequently, when a company fails, it's the directors and officers' decision-making that gets examined. In doing so, there's typically an objective standard that's applied retroactively to actions that were taken by directors and officers. So the court will basically look at what an ordinarily prudent person would do in same or similar circumstances, and courts do continue to defer to the business judgment rule. Courts will often look at the critical decision-making that was done by directors and officers during that financial period of insolvency and determine what actions were made to reduce expenses, how quickly they were implemented, what efforts were made to restructure the company's debts, what was done to conserve cash, did the company pursue the sale of any of its assets, and did the company consider an out-of-court workout, a Chapter 11 bankruptcy, or an assignment for the benefit of creditors. There are additional things that directors and officers should be cautious of when entering that zone of insolvency, and one of those things is avoiding personal liability. Typically, directors and officers are not liable for company debts, but there are certain requirements that directors and officers must take and things that they may pay attention to that may carry that type of personal liability. That includes wages, because there are certain requirements that employees are notified if the company is going to be shut down or if a branch of the company is going to be shuttered. There's also additional considerations for taxes and personal liability of certain types of taxes that may carry over to directors and officers. That includes things like employee portion of the FICA taxes. There's also some states that reflect that if the corporate charter of the company is forfeited because the franchise taxes are not paid, the individuals can actually be held personally liable for all of the company's debts. In addition to those considerations, directors and officers should really pay attention to what insurance they have in place to provide protections against these issues. So you should make sure that your D&O policy does not have any exclusions for insolvency or bankruptcy, and review your insurance policy to make sure that the policy is kept up to date and that there is tail in place to the extent that the company files for bankruptcy or enters into an insolvency period where there may not be sufficient funds to pay for a run out of those claims. Overall, directors and officers just need to remain vigilant when a crisis occurs and be proactive in taking decisions to mitigate potential risks. I appreciate you listening to this episode of Triage. I'm available to discuss these issues further, and I'm happy to provide advice on how to help navigate these issues. You can find my contact information on the K&L Gates website.
Thanks again for listening to Triage, timely conversations for healthcare professionals. New episodes are available for download through Apple Podcasts, Google Podcasts, and Spotify. By subscribing to Triage, you will receive timely notifications for each new episode. Also, if you have any topics you would like to hear discussed on Triage, please don't hesitate to email triagesupport@klgates.com. We would love to hear from you.